Alright guys, welcome to another episode of Geeked on Managerial Accounting. Today I'm going to be talking about chapter number 10, which is budgets and flexible budgeting. When it comes to budgets, there are essentially six types of budgets that I can think of from the top of my head. So you have sales budget, you have a production budget, and you have direct material budget, and you have direct labor budget, MOH budget, and finally you have the cash budget. All right, these are the six types of budgets that I feel are the most important. There are more budgets, but when you are covering this chapter in this class in your class, you will realize that they are very simple. Even these budgets are very simple. All they are is a certain format where you can just plug numbers in from the question. But like in this video, I'm not going to be covering any of the budgets. If you do need help like outside the classroom, if you didn't get it in class, you can always email us at inquiries@gmail.com, which I'm going to write out at the end. I'm just going to give you a brief overview of what these are. So like all these budgets can really help businesses to forecast into the future, right? Remember guys that budgets are always helpful to make decisions, but they are never totally accurate. They are never totally accurate. This is very important, guys. So when you have budgets in front of you, you cannot really use them to make major decisions. What budgets really are for is to like help you with decisions like sales growth or cost saving policy. So you want to forecast what your sales are going to be in January, February, and March in order for you to achieve a certain level of profit, right? So you can write out all the information and then you can see, oh, well, you made $2,000 of profit. And in February, you made like $4,000 of profit. In March, you made $3,000 of profit. And then you can decide, oh, in February, if you want $6,000 of profit, by how much your sales has to increase for that to happen. That is really what budgets are for. What I really want to focus on and what I'm going to do in a question is flexible budgeting. This is something that I personally got stuck on this, and a lot of my peers had trouble with this. So this is something that I really want to help you guys out on. All right. So let's get started with this, where I have a question in front of me. Tom's Telecom is a telecommunication business. Provided is a cost report for January. He sells packages of home phone, Wi-Fi, and television. And then provided is a list of information which I am going to explain what it means. So you have budget, actual, and variance. So budget, the list for budget is what you plan out at the start of the month. So this guy planned that he would sell 20 units. Actual is what actually happened during the month. So during the month, he actually sold 15 units. The difference between the two is your variance. So since he sold 5 less units than what he planned, that is 5 units unfavorable. U stands for unfavorable, F stands for favorable. Moving on to the variable cost, I want to cover some more to give you guys a general idea of what you're looking at. So this guy budgeted that his variable costs for home phone were $2,000, but they turned out to be $1,500 during that month. Since the costs were lower than what he planned, that's $500 favorable cost savings, really. All right, and then the list continues in the same way. So let's get started with this question. I have the same list on the next Excel file. So we're really going to start solving it. First off, what flexible budgeting really is to provide the owner or whoever is running the business with a more accurate budget. Since this budget isn't very accurate, since like actually this is what happened, right? This is not very relevant anymore for the owner and it cannot be used to make decisions. So you want to create a budget that is more consistent with this level of activity. So this budget was based on the fact that he was going to sell 20 units. However, he did not sell those 20 units. He actually sold 15, right? So there is a discrepancy there, and you want to correct that discrepancy by creating a flexible budget. Now, a flexible budget is simply this. A flexible budget, what it does is it takes your budgeted per unit variable cost rates and it multiplies it by your actual in order to find a budget that is consistent with the actual level of activity. Let me show you what that means. So first off, what I'm going to do is I'm going to find a per unit rate for the business for the variable costs only. Remember that it's going to be per unit rate for the variable cost only because your fixed costs are fixed. They do not change with the level of activity. We covered this in our chapter 2 videos. So like if you are still unsure about fixed costs, I'd advise you to have a look at those. So fixed cost does not change with the level of activity. You can sell 20 units, you can sell 15, you can sell 25. The fixed costs are going to stay the same, right? So we're not going to touch these two. We're only going to be looking at these and what their rate is for the budgeted level of activity. All right, so let's get started. For the first home phone variable cost, we're simply going to divide this by this. And I'm going to lock this in so that we can just drag it down. There we go. So that, my friends, is your per unit rate. That is essentially, this rate is what you budgeted it to be for each unit. Now what we're going to do to create a flexible budget, what you have to do is this. You multiply this rate by the actual level of activity to find a more consistent figure. So here I'm going to create my flexible budget, and this is what I'm going to do. So for a home phone, this 100, I'm going to multiply it with the actual level of activity, which was 15. And I'm going to do the same thing for all of them. So really, I'm going to lock this down again. And I'm just going to drag this down. There you go. Just to check, yes, that is right. So this is your flexible budget. And when it comes to your fixed costs, remember I said that they are going to stay the same. So it doesn't matter if they're budgeted or if they're actual. Your budgeted fixed costs are going to stay the same because at the start of the year, you know how much fixed costs you're going to incur. So your budgeted and your flexible fixed costs stay the same. All right. So that is your new flexible budget. It comes out to, okay, so let's total this out for total variable costs. This comes out to 2250, and your total fixed costs come out to 2200. So your total costs basically for the business are this plus this. That is 4450. Right now, this is your this is the budget that you can create based on the actual level of activity. Now, you want to compare whatever you found here. So this is your flexible, right? You want to compare this flexible to this actual budget that you have right here. So I'm going to copy this over here. There we go. And now we can really compare what is going on. So have a look here, guys. This is what's really happening. I'm going to minimize it a bit. So your home phone, when I made a flexible budget, which is more accurate, I can see that when it comes to variances, there is no variance. There is zero variance for home phone. When it comes to Wi-Fi, there is like my actual minus my flexible gives me a variance of 1500. Now guys, is this 1500 favorable or unfavorable? Well, it's actually unfavorable because your actual is greater than your flexible budget, right? So this is going to be, okay, so I should just write it out, unfavorable. There you go. And then again, the same thing over here, actual minus my flexible, that gives me 750, favorable or unfavorable. Since your actual is greater than your flexible, this is again unfavorable. So 750 unfavorable. Total, we can do the total as well. So it's going to be 1500 plus 750. Oh wait, 1500 plus 750. That is a total, my bad. That is like 2250 unfavorable. That's a total of these two. And that gives us a total of like the total variable cost, which is unfavorable, of a total of 2250. That's like comparing flexible and actual. When it comes to our fixed costs, they are like, let's see again. So actual is 25,000, flexible is 20,000. Favorable or unfavorable? The same question. Ask yourself the same question for each entry. So my actual minus my flexible, that gives me 5,000, which is unfavorable because my actual is again greater than my flexible. 5,000 unfavorable. When it comes to property taxes, it is 0 because they were both the same. There is no variance. So when I add it up, it's just 5,000 unfavorable, giving me a total figure of 5,000 plus 2250. That's like 5,000 plus 2250. That's 7,250 unfavorable for like all the costs involved. All right, guys. So can you see here how much difference there is in our two answers? This answer gave us this huge unfavorable 7,250, whereas over here we got like a small unfavorable value of 500. Notice how different the two values are. Do you see the considerable difference between the two? So this is why if you rely solely on your budgeted and your actual figures, that is why you can make a huge mistake. This is a small business, but think of a business that works like that has costs in millions, in billions. What kind of effect would that have on any business decision that will make based on these values? Right, guys? So that is why you have to be consistent with the actual level of activity, not the budgeted. So you have to convert this budgeted into a flexible budget and then compare it to the actual to make worthwhile decisions, really. All right, guys, so that is it for flexible budgeting. And again, if you have any questions, concerns, comments, and if you want to know more about budgets, the ones that I discussed in the first slide, you can always email us at inquiries2geeked@gmail.com. Alright guys, so stay tuned for more great videos and have a great week.